this is an exciting video because in this video I'm going to reveal to you for the very first time something that I have referred to in my other videos and courses but never revealed in electronic format. So far the only place that I've ever revealed this setup is in my live seminars, and I haven't done one of those for a long time, a couple of years actually. So this is the parabolic move pattern. It's a distinctive price pattern. It's very different than the regular patterns that you've learned in Foundations 1 and 2. And you really, it doesn't depend on the indicators. That's why I don't teach it in Foundations 1 and 2. There's actually two reasons. First one is that it doesn't follow the same type of energy as taught in Foundations 1 and 2, therefore you don't use the indicators in the same way. You can use them as supporting, but you don't always get the confirmation of the indicators, but you can still trade it without the indicators. Okay, and we'll look at exactly what I mean by that here in just a few minutes, but a parabolic move is a very extreme pattern, and so it doesn't have the same type of energy that we talk about in Foundations Course 1 and 2. Now, if we're in Foundation Courses 1 and 2, we're looking for a specific type of market energy, which is a normal market energy. How the market moves most of the time, which is why we teach it in Course 1 and 2. Most of the time, the market is, just making some nice, even, roughly symmetrical sine wave type cycles, waves, just kind of like that as a general textbook example. Okay, so just kind of moving, moves up, moves down, moves up, moves down, moves up, moves down, and that's it. And so this works very well. Actually, our indicators and the inputs to them are designed to measure this type of wave movement, and that's fine. But of course the market doesn't always move with that type of energy. Sometimes the market gets into a rather exuberant mode and this is usually when some sort of news comes out, and it can go vertical. So when I'm talking about parabolic patterns, parabolic pattern is kind of like that. It goes vertical, right, like that. So this is what we're talking about, is more of an extreme angle. So instead of the market going up like at this angle, it's going up more at this angle. So it's going up very fast. In other words, it's covering a lot of price, and that's your price range, price axis, in a short period of time. That's your time axis. As opposed to covering this much price in that much time, much longer period of time. Okay, so very extreme pattern, extreme energy, and our cycle indicator does not follow this, does not measure it very well. So therefore it's got kind of a separate category of its own. Now when do we see this type of pattern? What causes it? News causes it, but it has to be significant news. So rumors don't cause it, gossip doesn't cause it. I'll clarify that. Rumors and gossip, they can cause a quick vertical move, but what we're looking for is one that is sustainable, that follows through for a period of time. And for that to happen, market sentiment has to stay. It can't just be a quick, short-lived, knee-jerk reaction. That's what happens with gossip and rumors. We need some sort of substantial news where the market says, whoa, this is a surprise. And not only is it a surprise, but it's an important surprise that will continue to move the market in that direction. So it's an important surprise that has staying power as far as how it affects people's sentiment. Now the way that this will look with price bars is you'll get something like this. Okay, so here's your price bars, average range price bars, making their nice little waves, high and low, and then all of a sudden, boom, boom, boom. Okay, so you get your average range price bars, and then you get wide range bars. So this is another telltale sign of these vertical parabolic moves, is that you get wide range bars and usually very little overlap between them. There can be some overlap or there may not be. Either way is fine as long as they're wide range bars and they cover a lot of range in a short period of time, which if they're all wide range bars, they will, and they don't have a whole lot of overlap. Then after this first impulse move, this would then actually be, you know, if we haven't started a trend yet, say this is a channel over here, then the market will consolidate here for a little bit. Now it can do one of three things. Okay, let me draw this over here. It can either now it'll go to more narrow range bars. Number one, it can retrace up a little bit. Number two, it can just kind of go sideways and consolidate. And number three, can actually go down with narrow range bars and then continue. Each one of these, then we're looking for a continuation of some more wide range bars after it. Now these are textbook examples, and sometimes, you know, it's a little messier than this, of course, but these are the general archetype patterns, one of those three that we're looking for. All three are tradable, and it doesn't really make any difference which one of these it forms. As long as you have these narrow range, what we're doing is we are going to be looking to trade the breakout as the market. We want to trade inside of this little consolidation here and catch the next big move down, if there is one. Now, there may or there may not be. So the first retrace is always the highest probability, the second, and then there can be another one after this, see? And then you can go down again. So this would be 1, 2, 3, 4, 5. So, whoops, 5. So we're looking for a 5-wave pattern, but don't expect it to show up on your top dog custom indicators, because normally there won't be cycles on each one of these, because the cycle indicator, because these retraces are so short and the range is so small, so duration is small and range is small, quite often the cycle indicator %D does not have time to get back up to 45. And so therefore that's why you can't rely on the indicators with this pattern. Now sometimes it does, and if it does, that's great. Rarely will K ever get up to 80. So this is one of those cases where when the cycle indicator, if it does get back to the middle of the range, you can use that to trade. You can trade it. It's one of the exceptions to the rule of not requiring K to get up to 80 when you're trading a parabolic pattern. Okay? And you don't even have to wait for D to get up to 45 if it doesn't. If it does, it's better. It gives you a clearer signal. Okay, so boom, boom, boom. Comes down. That's your wave 1. Boom. And we'll be looking to trade the break of this low, the low of this bar generally, right here, the low of this narrow range bar. So as the market breaks it here, we would get in on the next big move down. Whether, now again, K normally will not get to 80 on this retrace. D may or may not get up to 45. If it does, and if we get a hook down on K with this bar here, our entry bar, then that is great, and that adds to the probability of the trade. And again, this is one of the few exceptions, this and reload patterns. And in the day trading course, we've got some exceptions there too, actually, where you are able to sometimes take these trades when the stochastic indicator only gets back to the middle of the range. Okay, so so those are the basic patterns. Let's look at it on some charts so that you can get a real feel for what it looks like outside of my messy drawing here. Alrighty, now parabolic patterns, by the way, they form most often on daily charts, I find. Again, currencies are really, really good markets for these. Intraday charts they will appear on as well, but mostly minute increment charts. You will not find these much on tick charts because, again, as you get these extreme movements, tick charts start to form more bars, so you don't get the wide range bars. So parabolic patterns do not appear well on tick charts. Okay, so anyway, here we go. Just one example. We get a pretty vertical move down. We get 4 wide range bars. 1, 2. We really don't want to see more than 3 bars retracing. If you get more than 3 bars retracing, then it's problematic. It's not as high probability. And when we get to talk about bar counting, that'll make more sense. We want very little energy. Whole point is you want as little energy on the retrace. So that's what you think about. Think I want extreme energy on the impulse, and I want as little energy as possible on the retrace. If you get a good candlestick pattern to enter on, that adds to the probability. And if you do, now see we don't get a cycle high here, but if you do get a hook on K, that's even better. Now here we don't, and here we almost do. It goes flat. So you could enter here, when in this case pip below the low of this bar plus the spread. We could enter here. Okay, so that is an example. Now the earlier in the trend that this happens, the better, of course. This one's rather late in the trend, but all the normal rules apply regarding probability. Okay, here's one I want to show you. So here we get this pretty parabolic, pretty vertical. Now what you do is just compare. Here's the easiest way to do this. Okay, compare the angle of that half cycle and that half cycle and then that half cycle. See how that is a much more dramatic angle down? So that's a parabolic move down. So now could we trade that? Well, we could look to trade it, but the problem is as we retrace, we get 2 narrow range bars. That's good, but then all of a sudden, boom. Right away you get a wide range bar going up. And so immediately with this bar, I would disqualify the trade. Because now, remember, what we're looking for, big energy down, dramatic energy down, very little, if any, energy on the retrace. And these 2 bars are okay, but then this one has a lot of energy going up. It's a wide range bar that opens at the low, closes at the high. Remember back to our candlestick patterns. And therefore that is not the type of bar you're looking for in a retrace after a parabolic pattern. So immediately after seeing this bar, done. We are not looking to take a trade anymore on that. Okay, here's another example. Here's a very extreme move down, very vertical move down. We would never look to trade this short. Why? Because, okay, it's early in the trend. We're just starting a new dramatic move down. But this candle right here is a bullish candle. That's a spike bottom reversal bar. What we want to see is bearishness all the way down. We want to see it close toward the low. But when we reject all this value down here, that makes this a bullish candlestick bar. And now, no matter what happens on this retrace, of course the next bar in the retrace also is, definitely not neutral. We're looking for more neutral bars on the retrace. And so therefore we're done. We're not, the pattern is broken. We're not looking for the short as a continuation here anymore. Okay, here's another chart. The best entries, the highest probability entries, will allow you to enter on a candlestick pattern. And so, as they all do. So here we get a parabolic move up. This is a rubber band trade, right? Rubber band trade, mini divergence here. So nice rubber band trade, and that works. But now we see, oh wow, got a vertical move up, wide range bars, very bullish, closes toward the high. We get a neutral bar. It's kind of neutral bullish, actually, because that's a spike bottom bar. This bar is neutral to bearish, but nothing's really going on. The real body is inside that one. We've got 2 basically inside bars here. This bar is bearish, and then we get a bullish bar. This is a close above the previous open. So now we're saying, okay, maybe I would take this. We would enter 1 pip above the high of this bar plus the spread. Now, a couple things is that would be our entry. We've got our 2-bar reversal pattern. First thing is it's been 4 bars instead of 3. So it's okay. Again, you'd want as few bars to go by as possible. 3 is kind of the ideal. 4, still okay. We don't have a cycle low, that's okay. But it is nice if K is angling up in your direction on these. It's not absolutely necessary, but boy, believe me, it sure helps. And K is not angling up here. And of course we are kept safe anyway because we never get a entry. There's no trigger. We never go above the high of that bar. And therefore we're kept safe out of this. But those are the kind of things that you want to look for on these parabolic trades. Okay, now here's another one. And so here we're into a contraction pattern, consolidation. And then boom, we get the big wide range bar. Now we get some consolidation bars. Okay. Now the good thing about this one is they're just going sideways. They're neutral, neutral, neutral. On this bar though, if you enter in above this bar, you are entering on K hooking up, number 1, so that's good. You're also getting in just above all the consolidation bars, and that also is an extra good sign. You'd be getting in up here. Now it doesn't follow through a lot, but you do, get a little bit out of that, and that's all it took. This one is just a 1, 2, 3 count according to parabolic patterns, which again is different than the regular sine wave patterns. Okay, another point about these parabolic moves is gaps are seen as parabolic moves. So they are, if you look, for example, here or here, or if you're looking at an intraday chart and you look at the open, sometimes you'll see a gap at the open. We consider that a parabolic move. That counts as a parabolic move. So just in your mind's eye, kind of see a wide range bar there. All right, so looking at this, for example, let's see, bring up my drawing tool here. So this is a great example because we get a boom, boom, 2 very nice wide range bars going very vertical, and then we get a very narrow range waiting period just going sideways, and then boom, it goes back down again, and then we don't really get another entry. We get a regular cycle high here. And this one is kind of also parabolic because even though these bars do not look wide range, it's the gap. So boom, and then you get this big space here. So we would kind of see that really as, keep a cleaner chart here, we would really see that as this bar going all the way down there and forming a wide range bar. Now this one's a little messy. We get this type of pattern here, but then we get a little bit of gap up into sideways bars, but then we get a very bearish bar here. So that's where I say not all these things form textbook patterns, and you got to make a decision as to whether you want to take that trade or not. The other thing that I want to make clear on these parabolic moves is you can your stops can be can be a lot tighter than normal. So for example, if I were to trade this bar, I wouldn't put my stop all the way above this high. I would actually put it above just the high of that bar, because if the market breaks this low of this consolidation pattern, but then it comes back up here above the open, well, that's not what we're looking for, right? We're looking for very strong energy, unidirectional, powerful, non-stop, one-way energy. So if it just breaks here and then it goes back in the opposite direction, it's just the wrong kind of energy for a parabolic move. So we can move our stops in tighter to that actual bar there. Okay, so that's parabolic patterns, and they're actually rather simple patterns. One warning, do not trade these. Don't trade any of this stuff with real money. Always start trading with anything new with a simulator and do it for, you know, a long time until you get a feel for these things. You got to see how they move in real life, and you know, take your knocks and refine it. There's just, I can't give you experience. It's the one gift I can't give you, and you can't trade effectively without that experience. So give yourself some time to learn these patterns through experience, and every pattern like this has nuances. And I can tell you as many as, you know, I can think of and so forth, but until you actually do it yourself, it's not going to be really clear and part of your own nervous system, which is what it has to become.